Wall Street's 2025 has been anything but boring. Tariff threats, wild price swings, and global policy uncertainty have investors on edge, scrambling to make sense of what comes next. But while most market watchers are bracing for impact, one voice stands out from the crowd: Tom Lee, head of research at Fundstrat. He isn't just optimistic, he's boldly predicting the S&P 500 will surge to 6,600, maybe even 7,000 by year's end. That's not just a recovery, it's a full-blown rally. So how did we get here? And why does Tom Lee remain so bullish when so many are fearful? Let's break down the chaos, the comeback, and the contrarian case for a new all-time high. On April 2nd, a day now known as Liberation Day, President Trump stunned global markets by announcing sweeping new tariffs. Nearly every sector felt the impact, and panic selling swept through Wall Street. The S&P 500 plunged over 10% in just 2 days, the worst drop since the COVID-19 panic of 2020. The Nasdaq Composite fared even worse, at one point down more than 20%. The cause? A new wave of tariffs targeting imports from China, Europe, and beyond, effectively reigniting a global trade war. Fear gripped investors and the VX volatility index exploded past 50, a level usually reserved for historic market meltdowns. But just as panic peaked, relief arrived. In mid-April, the Trump administration paused key tariffs for 90 days, giving businesses and investors a much-needed breather. Soon after, a limited US-China tariff reduction agreement added fuel to the rebound. The S&P 500 clawed back from its lows and the Nasdaq 100 turned positive year-to-date, helped by strong rebounds in select tech names. The recovery, however, came with an expiration date. On May 23rd, just as markets were regaining their footing, President Trump threatened a 25% tariff on Apple and other tech giants that manufacture outside the US. His message was blunt: make it in America or pay the price. Apple's stock tumbled 3% intraday, dragging the entire tech sector down with it. And that wasn't all. Trump doubled down, threatening a 50% tariff on all EU imports starting June 1st. We're not looking for a deal, he declared, sending shockwaves through boardrooms across Europe and among multinational corporations. The S&P 500, Nasdaq, and Dow all closed lower, and investor anxiety surged once again. Uncertainty became the word of the day. Against this tense backdrop, Tom Lee's bullish forecast might seem out of place, but his thesis is built on 4 data-driven pillars. Bearish positioning. According to Bank of America's Fund Manager Survey, U.S. equities are underweighted by 40%, the most bearish tilt in recent memory. Hedge funds have ramped up short positions at the fastest pace in a decade. To Lee, this is fuel for a rally, not a reason for fear. There's significant dry powder waiting to be deployed. Bitcoin as a leading signal. Bitcoin hit an all-time high in May, ahead of the equity market's recovery. Historically, crypto rallies have often preceded equity breakouts by a month or more, a pattern Lee believes is repeating. Volatility has stabilized. The VIX's wild ride from 50 back down below 30 mirrors previous market bottoms in 2020, 2022, and 2023. Lee sees this sharp contraction in volatility as a sign that forced selling is over and that investors are already starting to re-enter risk assets. Earnings remain strong. Despite macro turbulence, corporate earnings growth is holding up, especially in tech, AI, infrastructure, and industrials. These fundamentals act as a safety net for equity valuations. With these forces in play, Tom Lee is doubling down on his S&P 500 target of 6,600 to 7,000 for 2025, arguing that a breakout is likely in Q3 and Q4, especially if tariff tensions fade or become priced in. So what should investors do? In Lee's view, volatility is opportunity in disguise, but only for those who are prepared. With pessimism crowded and fundamentals resilient, the coming months could offer some of the best risk-reward setups of the decade. Here are 3 stocks uniquely positioned to rally if Tom Lee's bullish scenario plays out. While everyone chases Nvidia and the usual AI giants, Celestica is quietly emerging as a core infrastructure player in the AI revolution. And it's still trading at a valuation that doesn't scream bubble. That's rare in 2025. Celestica isn't just another hardware supplier. It's a crucial link in the AI supply chain, delivering custom-built platforms and advanced connectivity systems that power high-performance computing. With clients like Meta and OpenAI already on board, this isn't a speculative bet. It's a company with proven partnerships and rapidly expanding relevance in the AI data center boom. Celestica's hardware platform solutions segment has grown 65%, signaling a move into higher margin territory. Despite a modest gross margin, revenue is up over 21% annually, and EBITDA growth has surged past 40%, outpacing many better-known peers. While stocks like Broadcom and Supermicro command steep premiums, Celestica trades at a price-to-sales ratio of just 1.3, a rare blend of growth and value. Next up is Marvell Technology, a company that, despite a 40% plus drop this year, may be one of the most misunderstood and undervalued AI opportunities on the market. At first glance, the sell-off looks scary, but dig deeper, and you'll see a company that's not broken, just temporarily mispriced. Marvell is at the heart of AI infrastructure, supplying customized chips for data centers, cloud networks, and enterprise AI platforms. Revenue from data center AI products surged 78% in Q4, now making up 75% of Marvell's total business. In fiscal 2026 alone, sales are expected to grow over 40%, with double-digit growth continuing into 2027 and 2028. Partnerships with giants like Nvidia and Amazon make Marvell more than just a chip stock. It's a key enabler of the AI boom. What sets Marvell apart is its strength in custom compute capabilities, a niche dominated by only a few players. The global market for AI infrastructure is exploding, and Marvell doesn't need to win it all. Just a sliver of this demand could fuel massive upside. With a base case upside of 35% and a bull case of 100% plus, the current stock price under $65 might be the discount of the decade. Rounding out the list is a familiar name, Advanced Micro Devices. Once seen as overvalued during the peak of AI euphoria, AMD has quietly transformed into a compelling buy after a more than 50% drop from its early year highs. The stock now trades at a valuation rarely seen in the past decade, but the fundamentals and growth trajectory have never looked stronger. AMD's recent $10 billion joint venture with Saudi Arabia's national AI company, Humane, is a game-changer. The deal opens up a new market for AI infrastructure exports and positions AMD as a key partner for nations eager to build AI capabilities independent of China. Add in the ZT Systems acquisition, and AMD now has the tools to deliver full rack-scale data center solutions, putting it toe-to-toe with NVIDIA in the AI compute arms race. Data center revenue jumped 57% last quarter, yet AMD trades at just over 1x PEG, a massive disconnect between price and potential. With the rollout of its new MI series GPUs this summer and market share in CPUs now nearly 30%, up from just 9% a decade ago, AMD is clearly executing. This stock isn't just rebounding, it's recalibrating for a powerful second act in AI dominance. As we look back on the chaos of early 2025, it's clear that volatility is the price of admission for long-term gains. While tariff threats and policy shocks have shaken confidence, the underlying fundamentals, earnings, innovation, and resilient demand remain strong. Tom Lee's bold forecast may seem like a moonshot, but history shows that the biggest rallies often begin when fear is highest and positioning is most bearish. So whether you're a cautious observer or a risk taker ready to pounce, remember, in markets, the only constant is change. And sometimes the greatest opportunities come when everyone else is running for the exits. Stay tuned, stay curious, and don't let the noise drown out the signal. The next chapter of this bull market may surprise us all.